Welcome back to Reimagine 2020. Today, I am glad to be joined by Koroush Khaneghah, crypto trader and author of Market Meditations. I'm Yonah Hochhauser. I'm glad for you guys to join us. Now, Koroush, thanks so much for joining us. Now, for our audience who might not know who you are, you want to give a little background of kind of who you are and how you got into crypto?
Yeah, I'd love to. Firstly, thank you for having me on. I'm so stoked to be here. It's an absolute pleasure. I think what you guys are doing is awesome. Spreading that crypto message, educating the masses. That's how adoption happens. I mean, that's our biggest barrier. We've got the philosophy, we've got the technology. We just need to get the message out there and show people why it's incredible. So I got into cryptocurrencies late 2016, early 2017, that first bull run. I learned a lot from it and carried that knowledge over to turn into a crypto trader. And I went pretty much full time. I had other businesses. I always like to go have multiple streams of income and never rely fully on trading. And I grew a bit of a Twitter following, simply posting my trades live. So I had a live journal, which I did for about 45 days. And yeah, I just shared everything I did. And the following went from like 20 followers to a few thousand. And then I got a little bit nervous. I was like, oh, wow, people are following my every move. Maybe I shouldn't be pumping signals out and have people who don't have the right knowledge copy it and then lose money. So from that, I kind of transitioned into more of an educator in the space. So I thought, okay, just giving people fish doesn't do anything because they get to eat for a day and they likely don't know the right things to do. So they end up hurting themselves in the process. And I just swapped to education. I started teaching people about how I trade, the basic tools, expanding beyond that. I started teaching risk management. Right now I'm working with Engrave, a big cryptocurrency security company, to get out the security message. Bitcoin is at $18,000. So hackers have more incentive than ever to come take for sure. Hackers have more incentive than ever to come take our crypto. So move to that education motivation. And yeah, the Twitter stayed kind of like a part-time thing for a while. Then we got COVID, unfortunately. And a lot of my other businesses, well, they were tourism based. So I had my biggest other stream of income was tourism based, and that took a huge hit from COVID. So I decided to, after taking advice from a few of my mentors in the space, a big shout out to Scott Melker, who really pushed me in this direction. He said, okay, listen, double down on Twitter. Crypto is going somewhere, build this brand, educate the masses, start up a podcast, start up a newsletter, do everything you can. And I just decided to double down on it and built a team around myself. And since then, I've been working with lots of different companies in the space, pumping out content, spreading the message, growing the brand, and yeah, doing everything I can.
Wow. Now, before you were trading crypto, did you have like a financial trading background? Were you a technical analyst? Do you know how to read a chart? Or kind of you got into crypto and then that got you interested in trading and you kind of taught yourself the rest?
I love answering this question because a lot of people can relate to it. So I started off purely as an investor. In fact, I didn't even believe trading was possible. I didn't think you could make money. You couldn't outperform the market over a long period of time. It just didn't make sense to me because all of, at least in the academic field, technical analysis isn't hugely respected. It's not seen as a hard science because it's very hard to get a huge sample size of data supporting different methods or patterns, because what an academic will do is they'll take like a head and shoulders pattern and then they'll test it across every single market and say, see, it doesn't work. It's just a coin flip. But there's a lot more to it. Trading is a bit of an art and a bit of a science as well, which obviously I realized coming into crypto, because crypto's a hugely inefficient market, especially in 2017. Still, I think incredibly inefficient. And you'll hear this from a lot of traders that transition over from the legacy markets over to crypto markets. They'll tell you this market is ridiculous. Like, you can find manual arbitrage opportunities and make a living off of those. I mean, that's unheard of in the current legacy market. So yeah, because it was so inefficient, basic technical analysis was working. And I noticed more and more people doing it in the social media space. And I thought, okay, wow. So I'm investing in crypto and I'm doing great. I've got a mathematics background. Maybe I should try get involved in the trading side. And I started watching, learning, consuming as much knowledge as I could, put together a basic trading system. It worked fantastically. And then I just built from there.
Wow. Now, yeah. And you know, like you mentioned, you got into the game a little while back, but I think an issue that a lot of people face, you mentioned Bitcoin's at 18,000, it hit 18.5 earlier in the day, and I think it's a little bit below 18K right now. There's this idea of FOMO when it comes to crypto and life in general, but also FOMO in crypto, where you see this price going up, everyone else is making money, you want to hop in. Now my question is this: Bitcoin's at 18K right now. Is it too late for the people who are not on the wagon yet? Is there that much higher to go? Is it the smart investing move to go long at 18K, or should someone wait for the market to go back down first?
Dude, great questions back to back. I absolutely love that. That's one of the most common questions I get in my DMs. Is it too late? Is it too late for me to buy Bitcoin? Have I missed that opportunity? And my most common answer is, if you have to ask me, then no, you shouldn't. You don't have enough knowledge yet to do so. And this goes back to what we were saying about like giving someone fish or teaching them how to fish. Take a step back. If you need to ask anyone, just forget about it. Don't throw your money where you don't understand what's happening, because even if it is the right move, emotionally, you're reinforcing a bad habit of making an investment or making a trade without having a right strategy in place, which might work out in the case of Bitcoin. But what about next time when it's not Bitcoin, when it's a bad investment and you repeat that behavior over the long term, over a career, you're going to end up losing money. So to answer that question, what people need to figure out is whether they're traders or investors. That's the first thing you got to do, because trading and investing are completely different. If you're long-term investing, what you need to do is figure out, first of all, your risk tolerance. Like, how much risk can you afford to take on? Where does Bitcoin fit in the overall picture of your investing, of your net worth? So how much stock exposure do you have? How much exposure to real estate? How risky is your job? Do you have responsibilities? All of these different factors need to come into play. And then you need a long-term plan, like what big expenses do you have coming up? All of these things need to be thought through. And a great book, which I'd really recommend to your readers is, to our listeners, is A Random Walk Down Wall Street. It's a book about passive investing. It'll teach you about all these sorts of things: time horizon, risk tolerance, about how to spread your portfolio, strategies like rebalancing, all of these phrases I'm saying. If you read that book, you'll learn a lot about it. And then you won't have to ask me, is it too late to go into Bitcoin? Because you'll take a passive approach and you'll start looking at it in your overall picture. So as you can see, for me to answer that question, you'd have to give me so much more information. It's not a simple yes or no answer. Then we can go to the other side as well and look at it from a trader's perspective. And this answer is actually a lot more simple. Do you have data backing your performance? If you do, then yes, probably it is the right decision. Not financial advice, but if you have enough historic data supporting the decision you're about to make, then it's the right one. If you don't, it's the wrong one. And it's as simple as that for the trading answer.
Mm-hmm. Well, I do respect that answer, because I do think a lot of people in this space are just shilling a good product. They're just yes men, and they're going to say yes to everyone. So I do appreciate you taking that very nuanced answer. Now, when we're talking about historical data, when we look back historically at Bitcoin, when the mainstream, when it starts skyrocketing in price, and when the mainstream starts talking about it, when they say that when your grandmother starts talking about Bitcoin, buy altcoins, and when your grandma starts talking about altcoins, sell everything. Because it does seem like this has happened in the past, where once the mainstream starts hopping on the Bitcoin wagon, that's when the market crashes or corrects, goes back down, however you want to call it. Are we going to see that similar thing right now?
Yes, probably. There will come a point where the bull market ends. But when that point comes, that's a much more difficult question to answer. Like the other day, Citibank analysts gave the target of 300K. They said Bitcoin is going to go to 300K. And they used the comparison between Bitcoin's 2010, 2011 price action to gold from 1970s. Now, you can take these sorts of predictions. You could even like draw a simple Fibonacci extension and come up with a random price target. But the problem is, Bitcoin doesn't have that much historical data behind it. It really doesn't. And then when you take a look at the 2010, 2011 Bitcoin price action, it's a really small sample size. Like, compare the market participants back then to the market participants now. I mean, how much is how the demand and supply dynamics worked back then relevant to right now? Do you see what I'm saying there? It's like it's hard to compare that data, and it's hard to extrapolate on that data. So what I would say is, we know as a whole that greed is a huge part of these market cycles. People are going to get extremely greedy and the price is going to go up high. It could top here at 18,500. It could top at 35K. The thing is, you need to have a plan on how to action against that. So instead of trying to predict where it's going to go exactly, be prepared for the inevitable end of the cycle and have measures in place to protect yourself from that. To give some examples of some actual tangible measures which our listeners can use. If you're a trader, a really simple one to take advantage of super parabolic trends like the one we have right now that don't retrace much is just a trading stop loss. So try build a system around a trading stop loss, which is just a stop that follows the price with a bit of distance. Or another one you can use is just use a moving average to the same effect. Like you stay with the market until that moving average gets hit. And how do you figure out which is the right method? All comes back to back testing. So go take as much data as you can and try to come to some sort of reasonable conclusion. As much as you can, use recent data over past data. And then if we go back to investors, again, this time we can look at rebalancing. So treat Bitcoin for what it is. It's a high risk asset with asymmetric upside potential and great fundamentals behind it. I think most people should have it in their portfolio. Once they understand how to manage a portfolio, they will see that it fits perfectly in. And then from that perspective, how to take profit is like what I'm doing is Bitcoin right now keeps rocketing up and it's 95-ish% of my total crypto exposure. So every time it goes up and it's way more than my real estate or my stock exposure, I rebalance. I take some profits based on a systematic robotic procedure where it just funnels into my other assets to make sure the split is what I want it to be. So then it doesn't matter when the top is. It doesn't matter when it dips because my system handles itself.
Mm-hmm. Well, you're really a really bad person to interview because you give such reasonable answers. Stop giving such reasonable answers. Now,
I'll do my best.
Yeah, no, and you're talking about this rebalancing, and so essentially you're just trying to keep. You have your strategy, and when you mention the strategy and robotically, is it automated? Is this set in stone that like literally once the price hits a certain point, the percentage goes imbalanced, and then automatically your Bitcoin is being sold to fiat, which then gets funneled into your real estate portfolio or whatever it be?
So it actually used to be entirely automated up until a year ago. And again, you'll keep hearing me talking about mentors telling me to do this and that. I love learning from as many successful people as I can in hopes of replicating that sort of success. Now, before I used to be entirely robotic, and most newer traders or investors should be robotic, because when you're robotic, you're less prone to emotional mistakes and your discretion. What I mean by discretion is your kind of subconscious processing to figure out what to do. So something that's as robotic is percentage goes up X amount, you move it to some other place, Y amount. Now, when it's discretionary, it's like it goes up X amount, you sit down, you have a think, and then you decide how to split that money. And the thinking part, that's what makes you prone to emotional mistakes. And your thoughts, your opinions are useless when you start out trading because you have no experience. You have no reliable data to go on, reliable experience. Because once you've spent ages staring at charts, or once you've seen market cycles again and again and again, you end up having subconscious processing, which is what I mean by that discretion, which is actually useful. So about 3 years into the trading journey, and I've been investing much longer than that as well, one of my mentors said, listen, you've got enough experience now. You've been living the crypto market day in and day out. It's time to start using your discretion. Start focusing on the news, start focusing on the fundamentals and what's going on behind these things, and use your discretion to aid your trading and investing decisions. So coming from a mathematical background, that was one of the hardest things for me to do. But as soon as I started adapting that to my trading, my win rate started going up. My investing has never been more successful. So what happens is now that robotic process, the rebalancing tells me, okay, it's time to put the money elsewhere, but my experience and my discretion helps me decide, even though the robotic process says I should do this, I think I should change this a little bit because it's not what the numbers say, but my experience and my discretion tells me I should do more of that. Hopefully that answers the question somewhat.
Yeah, for sure. In my mind, I'm just imagining in episode 4 of Star Wars, where Luke's flying the X-Wing and the system's telling him to shoot, and then Obi-Wan, the spirit of Obi-Wan's like, let go, Luke, feel the Force. And kind of, you're not listening to the robots. You're so in touch with the Force or your discretion and subconscious that you're allowing that to make the decision. So awesome,
I mean,
awesome there.
I'm getting that. I'm getting that slowly because I'm quite young, and when it comes to investing, you really need years and years. The beauty of crypto is it moves at such a fast pace, and it's a 24/7 market that we've just been able to see what most stock traders see in their entire career in just a few years. So the relative experience you gain from it is good. But again, I admit that I'm not a professional investor. I haven't made billions or hundreds of millions like a lot of these high, super experienced people that I look up to have. So I also acknowledge that I need to come at this from a point of humility. I need to know that it's not time tested yet. Give me another decade and then I'll talk with a lot more confidence, or maybe I won't. I'll try to maintain that student mindset. But yeah, so I just wanted to acknowledge that all of this is my learning process. I'm 4 years into the trading journey. I'm, let's say, 8 years. I could be wrong by like give or take 2 years for the investing journey. But yeah, so just wanted to clarify and put that in context. Yeah.
Well, I mean, we started off the conversation talking about how still inefficient the market is because it's so new, because it historically has been mostly retail investors who get emotional, who are new to the game, who are greedy, who get FOMO. But now we're really seeing this major shift in institutions and institutional traders coming in. And you mentioned how when you look at a legacy market, these inefficiencies don't exist because it's so heavily institutionalized. It's so heavily saturated by institutional traders. So my question is this: you said you've been trading for 4 years crypto, 8 years investing overall. Have you seen this shift in the big, especially we're talking about Bitcoin because I don't think institutions have hit altcoins yet, but we're looking at just Bitcoin. Have you seen that shift in the fundamentals, in the way the market reacts due to this influence and this incoming of these institutions and big time players? And does that affect the way that you trade?
Fantastic questions, one after another. Absolutely, it has. And I don't see it in the sense that I see specific data changing in the price. I see it through alpha decay. Simple systems that I had before just stop working. If I find a really big inefficiency, like in, when was it? 2018, either the first half or a second half, I can't remember. I had a strategy which traded the EOS USD pair, and that was making 1% a day. It wasn't, the portfolio was only about 50K, but it was making 1% a day on 50K, which is ridiculous. And it was just scaling up and up and up. And it had a ridiculous win rate as well, alongside that exponential growth of over 90%. And I'm a mathematician, so I just know this is not sustainable. There's no way this is going to keep going up. Eventually, I'm either going to run into liquidity issues or the edge is going to disappear. And not long after, the edge disappeared. The same thing has even happened in the altcoin markets. These edges just slowly disappear one after another. Now, I used to primarily trade altcoins and have only over the past year and a half swapped to majorly trading Bitcoin. And that's because I was getting tired of all the liquidity issues with the smaller market caps. So I moved purely to Bitcoin. And again, you just have to constantly adapt your systems to the different market conditions. No one system will hold in place. No one system will continue working. And yeah, I guess that's the only way you see the market getting more sophisticated. It's not like institutional investor in, now this whole thing is wiped out. It's more a gradual process of there being less money to be made in the market.
And do you see that eventually, if we continue in this trend where more institutions come in, to the point where the institutions really dwarf the retail investors, do you see, the crypto market as a whole mirroring the legacy market where it's really just the institutions and there isn't the inefficiencies anymore? Do you see it market becoming more and more efficient to the point where it's like, hey, I'm no longer, a Bitcoin now. We have to find that new thing to trade?
Yeah, I mean, until we have hyper sophisticated self-learning AI trading the markets, it's never going to be perfectly efficient. It's just not how it works. And there'll always be times of irrational exuberance. I mean, the stock market is like hundreds of years old, and we've got like 150 years of quality data behind it, but we still see absurd movements like with Tesla. Now, you can argue that the price movement is justified, but I don't think Tesla's company development quite reflects the development of the price. So you still see these times of irrational exuberance where if someone has a trend riding system, that's an inefficiency which they could have made a fortune. In fact, I know people who have made fortunes off of Tesla. So the inefficiencies will always exist. They just become less frequent, less exploitable, and more difficult to find. And that's what we want. That's actually what we want. All traders should aspire to eventually become investors, portfolio managers, take a step back unless they genuinely love the act of trading. For me, trading replaced the video game addiction. So I'm just like, it's amazing. This is like a video game. I love it and it rewards me with money. And I limit the size which I trade because I don't want that stress. So it's good. If you're in crypto right now, if you're trading, if you're investing, you want the market to become more mature. You want this to happen because that means adoption's coming in. That means there are so many smart people now. The price is more fairly valued. Volatility is reducing. I mean, Bitcoin is not going to get to where we want it to get if volatility doesn't decrease, if the market doesn't become more and more mature.
I mean, so first off, full disclaimer, I invested in Tesla at $245 in 2014. I then sold it in 2016 to pay my rent at $245. And now I cry myself to sleep every night as I see it go up. That's one. Two, you mentioned before, so clearly do not trust any trading advice I give. Now, you mentioned that before you started mainly in trading Bitcoin, you actually were trading in altcoins. And so my question is, with altcoins, especially, they probably have less historical data because they are newer. And I feel like they're a lot more emotional and erratic. How could you accurately trade altcoins when it's a shit show in my eyes?
Are you sure you're not a trader? Because these are fantastic questions, as if you are a trader.
Well, I'm an interviewer, so I hope I ask good questions, but I cannot trade at all.
Yeah, so again, another fantastic question, and it's a problem I ran into. So the way I compensated for this was, well, two parts. I say compensated. On the one part, anyone who gets into trading has a very high risk tolerance, and you cannot deny there is an element of gambling which comes with trading. I mean, we are just going to a casino where we believe the expected value is in our favor. So we have positive expectancy and we'll make money. And with altcoins, a lot of them didn't have enough history, and that made it very, very difficult to trade them. So my philosophy was, and this was my theory. So when it comes to developing a trading system, the first place you start with is with a hypothesis. Like, what's my idea and why is this idea going to make me money in the markets? And with altcoins, the idea was that, specifically Binance, because that's where I was mostly trading, not the mid cap ones, but the low mid to small cap altcoins tended to behave in very, very similar ways when it came to strong trends. So what my system did is identify these strong trends and then try catch them mid-trend and then get quick scalps to profit off of them. And this was all I tweeted about in 2018, pretty much. And so the way I got enough data for this was I've categorized them. I put all of these altcoins into one category, and I'm treating them as a very similar asset. And what that does is it means I can accumulate the data. So I can test the data across multiple different altcoins. And even though it's not got a long time period, there's a lot of density in that because I'm treating loads of pairs in a very similar fashion. Hopefully that answers that question.
Yep, that answered it perfectly. That's a great strategy. I never would have thought of it. This is why you're the math guy. Now, when we're talking about altcoins, and if we look at 2017, it was a very different market, I see, dynamic, because I think that DeFi is really taken over that spot. Oh, yeah. Now we're talking about altcoins. Now a lot of the big ones are DeFi based, DeFi focused. We're talking about Link, Aave, which was Lend, and onwards and onwards. Now my question, and to you as a trader, when you're looking at DeFi and DeFi tokens, I want to get your thoughts on that, because there's a couple different aspects here. Because when we're talking about DAO tokens, DAO governance tokens, for like a Uni token or CRV, that they're not only have value that fluctuates, but they also have a claimed use case that could be used. So as a trader yourself, when you're trading these tokens, how much are you weighing into it the added value of being able to actually vote on proposals? Or are you merely treating them as just any other cryptocurrency asset that fluctuates in value?
So this comes back into more of the discretion side, what we were covering before. So back in 2017, 18, when most of the portfolios that I was trading was sub 100K. So I wasn't going anywhere near above that. In fact, sometimes when the volume got so low on Binance, even like a 10K position would heavily impact the market. In cases like those, I really don't care what the underlying assets are. Like, it doesn't matter to me. I'm not a significant player in the market. I'm just trying to grow these relatively not so big portfolios. I'm not trying to like come off as arrogant saying those aren't big portfolios, but relative to what big players are trading in the market, those are nothing. Like in the Bitcoin market, if you put up even a 1 mil position, it's not that big. It's not like that crazy. So in those cases, I didn't really care. But when it comes to more recently, when I'm trying to bring that discretion in, when I'm trying to identify assets which are going to overextend and that I can put some more serious capital behind and look to make more ROI on my time, not trade smaller positions constantly and scalp that up, but look for less but bigger plays, then the fundamentals start to matter. Then I start shifting to assets like Link. So the reason Link really appealed to me is because it had a lot of synergies between the previous testing I'd done on these overextending altcoins, but also had a lot of fundamental backing behind it. So the coin has a fantastic community. It's a first mover in the Oracle space. It's got a lot of other fundamentals behind it that make it a very solid coin token. Now, there are some arguments against the actual use cases of Link, but so this raises an interesting point, just to go on a small tangent. It's the facts matter less than the perceived facts. So the perceived facts behind Link were the ones I mentioned, and no one really talks much about that sort of use case. So I care about the perceived fundamentals more than I care about the actual technical fundamentals of the coin, especially when it comes to trading, because it is all psychology. If you tell me you've got an Oracle coin that is 1,000,000 times better than Link, in fact, let's move to Bitcoin. We've already got coins which are way better at doing the job we want Bitcoin to do than Bitcoin, but because the perception is different, because the underlying philosophy isn't the same, the brand isn't the same, it's not going to have the same price and it's not going to overtake it. So it's very important when I mention fundamentals and underlying use case, I care more about the perceived ones than the actual ones, especially when trading. So yeah, recently a lot more that matters because one, position sizes have increased, and two, because I'm trying to use my discretion. And I'm not going to use my discretion on a coin which I know is absolute garbage and it doesn't really have any use case. So I'm not going to pick up any random coin and try trade it unless I'm having a bit of fun or going for much lower position sizes.
And if as a trader, I'm sure if you were to enter into your models that instead of buying the token at $1, you could actually get it handed to you for free, that would always work out. So now I want to get your thoughts on yield farming, which is a kind of a relatively new, I mean, it really blew off this past summer, but yield farming, where essentially you're taking your tokens that you already have, that you already have exposure to, and instead of just holding them and playing the market with that exposure, you're actually providing liquidity and then being rewarded not just with the transaction fees, but because every protocol wants to attract liquidity to their program, they're actually giving you their own token on top as a reward. So as the mathematician, as the investor, as the trader, how are you on top of the trades, on top of following your strategies? If you're already going to be having that exposure to that coin, are you yield farming with that coin as well?
So the yield farming one's a very interesting question because there are people making absurd returns on yield farming with relatively no risk. And I use quotation marks there for people just listening, because there's no such thing as no risk. And I'm a firm believer that in most cases, risk and reward are correlated. So if you can put money into an index fund in the stock market and make 8% a year, and that's considered relatively risky, it is. Like, the stock market is not a safe investment. It's
the S&P 500 index fund is not considered a low risk, because I just put all my life savings in it. Should I be scared right now?
Sorry, no, low risk, no, high risk is very, very relative. Like, take crypto out of the picture and then take the traditional stuff you can invest in. So what I'm comparing it is to cash, to bonds, to real estate. In that context, like your real estate isn't going to take a 40% dip one year unless it's a very uncommon event, although has very recently, but the perceived risk is a lot lower of bonds, real estate, and cash to something like the S&P 500. And then you can level that up to individual stocks, to something like blue chip stocks if you want hyper risk.
Or to crypto.
And then to crypto, exactly. So let's take that as relatively low risk, but somewhere I'm very comfortable having my long-term wealth in, and then scale it up from there. So now the stock market's got risk attached to it. You can lose money in the stock market. That's a fact, even the S&P 500, and that's giving you 8% a year. And then suddenly this thing's offering me sometimes 100% a year if I do it manually. If I go through an app and do absolutely nothing, it's giving me 20% a year. Immediately in my brain, I'm thinking, something sounds too good to be true. It normally is. So there's a lot of risk attached to it, simply just looking at it from that risk reward correlation perspective. And then you can dive deeper into it and think, okay, well, in my mind, as long as the amount of money you can make from this gradually decreases, that's what I want to see. I want to see the amount of money I can make from this gradually decrease. And that's when I feel comfortable that this is safer. And in fact, I will increase the amount of money I have in it as long as that happens. That's a very easy variable for most people to isolate and use as a means of like, okay, so this is super inefficient and it is risky right now, but the market is acknowledging it and therefore reducing that amount. But if that amount doesn't reduce, then you can see why there's probably an issue over there. So yes, I do it. I don't do it manually like these people making absurd returns, but I do use a few different apps to do it. And I got into it manually a little bit at one point, but there's just better ROI on my time elsewhere right now. There's so much money to be made in crypto. I mean, I'm sure you know how expensive sleeping is right now.
Yeah, well, so that's the other thing, you know, if you're talking about legacy markets, one of the biggest differences I'd say from legacy markets to crypto markets is the legacy markets go to sleep. They close, there's the closing bell, and they're done. And you don't really, I mean, of course there are after hours trading, but you don't really have to worry as a legacy trader. When you go to sleep at night, they're going to wake up and your position is destroyed. But with the crypto market, that is a reality. So as a trader, I'm sure I don't want to talk about emotionally because it has to be a wreck. But I mean, is it just every night before you go to sleep, are you just making sure that all your positions have stop losses? And am I correct in highlighting this difference between the legacy market and the crypto market?
Okay, so firstly, you're absolutely correct. And let me start this by saying, everyone listening, no matter how much wealth you have, it means nothing without health. I mean, someone who has a terrible sickness will trade every penny of wealth that they have to get rid of that sickness. And if you don't have the energy to enjoy your wealth, if your mindset isn't positive and happy, that wealth isn't going to mean anything besides maybe if you're very insecure, temporarily fill that hole. Besides that, it's got nothing else. So yes, this 24/7 market is very different. And yes, it can be brutal. And I'm trying to emphasize the seriousness of how brutal this can be. In actually the system I mentioned where I had that really high win rate and it was doing really well. I was actually trading multiple different portfolios on that same system to the point where I had alerts going off about 6 times every single night when I was sleeping. So I went over to my girlfriend's house
you were manually changing. Why at that point you didn't have it automated, at least when you're sleeping, to do the trade?
Manually. It was all manual because it required a little bit of discretion. Even though it was pretty robotic, I needed a little bit of discretion to execute, and positions lasted from 1 minute to 2 hours. So I'd wake up and then however long it take, I'd have to be there for it. It was stupid. At that point, I didn't know the value of sleep. And so I'd like sleep in the living room with my laptop when I was over at my girlfriend's house with her like parents. So I wouldn't have to, wake other people up and I could still keep trading. That's the level of obsession it got to. And it gave me insomnia for 2 years. And then recently again, this wasn't even trading. This was just when I doubled down on the social media and working with different cryptocurrencies. It's so expensive to sleep that my sleeping cut down to 4 hours a night for ages. And then I got COVID, and then I got COVID really badly. I had a fever. My energy levels plummeted, completely lost sense of taste and smell. Luckily, I didn't get it. I'm still young again. I didn't get it as bad as someone who's got respiratory issues or anything else, but that hit hard. And again, reinforces the message of health over anything else. So don't give up your sleep for it. And as a solution, just don't open positions that you're going to have to keep overnight. And if something's going to happen overnight that destroys your position, that's not a sustainable trading style for you. So like figure a way around it, either automate it, either restrict your trading hours, and even incorporate into your system the fact that you have to close it before bed. Sleep, I can't emphasize how important it is for everything in life. Having gone through the insomnia, having been hit by COVID, really just drive this home to the listeners. Prioritize sleep. It means everything. Another great book recommendation, Why We Sleep by Matthew Walker. I'm pretty sure that's what it's called. Fantastic book, and it'll teach you all about keeping your sleep good and why you need to sleep as well.
Mm-hmm. Well, I mean, luckily, sleep has never been an issue for me, and I'm very grateful for that. I also don't trade. So there might
definitely a link there.
There might be a correlation or causation happening there. Now, a similar question to the yield farming question is one that kind of gained some traction over the past week or two. Was with ETH 2.0. Ethereum 2.0 is slowly but surely coming along, and they launched their staking contract last week. And there was a lot of talk on crypto Twitter. Is it worth staking my ETH? When I could be yield farming with it, I could be just trading it. Because right now, the issue being for those who are staking on the ETH 2.0 contract, estimates are you won't be able to touch it or move it for like at least 2 years. So that's a really long position to be on. So as a trader, and now this is asking you both as a trader and an investor and a mathematician, I'm asking you, what are your thoughts on staking Ethereum right now? And I'm going to already highlight, I'm assuming one thing you're going to answer, which you said before, which was, as long as you see the return on investment going lower, you're happy about that. And that is what's happening with ETH 2.0. The amount of stake in your return on investment will be lower. But what is your overall view on staking at this point, this early on into the ETH 2.0 staking contract?
Well, you said it, you kind of answered the question in there. I mean, you have things like yield farming. You have so many different places where you can get ROI in the crypto space, which is so fast moving and so volatile. I don't want my money locked up for 2 years anywhere. I want that access to that liquidity when it's such a high risk market. So if it was a tiny percentage of my portfolio and I wanted to dabble in an experiment, sure, I'd go for it. But there's enough returns, there's enough opportunity in the crypto market to which I don't even need to consider the ETH 2.0 staking yet, especially at such an early stage. It's not a really long answer, but that is my answer to that. It's I see better ROI elsewhere right now, and it's not something I'm hugely focused on.
Now's the question that I'm actually most excited to speak to you about, because this is a question that I've been talking to a lot of projects, a lot of people for these conferences, and they're usually the heads of teams or they're building a solution. I don't get the opportunity to speak to many traders, and of those traders, I don't get to speak to too many traders that I don't think are total bullshit. I think that you base off numbers and you're relatively straightforward and honest. So I do feel confident asking this question. When we look right now at the state of crypto and definitely at DeFi, it seems like a lot of the financial products that we're seeing in DeFi mirror or just are decentralized versions of legacy financial products, except for one that I think really sets it apart from the traditional market, and that being flash loans, true short-term flash loans. There are similar things in the legacy market, but I'm yet to see something that really is as powerful and as unique as that in the legacy market. And I think it's a really powerful tool in crypto. It's also a very dangerous tool. There's been a lot of exploits recently utilizing it. But for you as a trader and as someone who really crunches the numbers, what kind of trading opportunities and what is your view on flash loans, as a trading vessel, as a trading tool?
Well, I haven't looked hugely into flash loans up until the other day. So it's funny you mentioned this now, because I was looking at the 6 million attack, which we took a hit on the other day. Like there was a flash loan attack for 6 million. But yeah, besides that, I haven't actually looked into flash loans hugely and don't incorporate them into my own personal trading yet. So unfortunately, I don't have a good answer for that.
Well, someone who's looking for market inefficiencies, all these hacks, they weren't hacks. They were playing by the rules of the system, and they realized that they could make an inefficient market way more inefficient by just dumping, by withdrawing or depositing that protocol's native token, because these protocols, they depend on price oracles to get their prices. So if they're either withdrawing or dumping the local token, then that price oracle is varying widely the price from another protocol. And so they're taking advantage. They're making the markets purposely making them more inefficient, and then taking major advantage of that. And so that's why I was curious to ask you about flash loans, just because it seems like it's trading on steroids. It really kind of like leverage trading, in the sense that it allows you to superpower your trading way more than what you would be able to do based off just your regular capital. But I really love this idea of the loan only going through once the numbers are right. You set in the parameters. I, as a lender, will only give you the loan if you already can pay me back the loan. Because computationally it's instantaneous. Obviously, it's not really. But I mean, that's always just fascinated me. So obviously, if you haven't looked into it yet, I want you to look into flash loans more, and then I want to hear your opinion on it.
I will. I want to look into everything. I want to look into every single coin that is pumping like crazy right now. I want to look into every single opportunity in the crypto market. And that's why I'm so focused on the concept of ROI on time. Before making any decision, I just need to filter it through. Like, is this the most ROI on time for me right now? Do I want to double up on the trading? And what it's come down to with the trading is, right now, I'm mostly very, very comfortable trading Bitcoin, Ethereum, and also Link. Those are my main trades. And then what I did not too long ago was actually assemble a team to help me pick out the right DeFi investments, because I missed the early DeFi train. I have friends who have made $12 million off Yiffy alone. So insane amounts of money to have been made. And I slept on it for a while because I simply did not have the time to double down. No, not that I don't like that phrase. I did not have the time. I did not choose to spend my time on DeFi at that time. And I still didn't want to. So what I did was get a team who can pick out these projects for me, who can select the right projects for me to invest in and do the right stuff in. So yeah, it kind of highlights the point of the importance of getting people who have that knowledge that you don't have and learning from them. Like you just gave me a bit of a crash course on the flash loans, which I looked into literally the other day. And that was my first knowledge of them, which was that attack. And now I know even more about the attack.
Well, I mean, don't worry about it too much, because by the time you actually go to do a flash loan, there'll be a new financial product in DeFi that will already give better returns and more powerful and yada yada. All right, so listen. I know that you really value your time very much, and I don't want to waste your time. So this is the last question before I let you go. You are based in the UK, and recently the UK government put a ban on crypto derivatives. They claimed that retail investors weren't smart enough to know how to trade them. They claimed they were losing money on them, and a bunch of other claims. And when they actually released the survey that they put out to UK traders and institutions and players, 98% of the survey respondents said they disagree with the ban. They understand the products. They are making money. So I want, as a UK crypto trader, I want to get your thoughts. What are your thoughts on that UK crypto derivatives ban?
Man, this ban caused me so much headache. It came out of nowhere. I mean, it was in process for 2 years before it actually got executed. I just didn't even think it is possible that it'd go through. So it wasn't on my radar. I don't think anyone did. Well, according to your survey, which I actually missed that survey, 98% of people did not think that should go through. And it really doesn't make any sense to me. I've read through the entire thing alone with lawyers, with multiple different lawyers, with consultants. So it's definitely a very important thing to understand as a trader. And the reasoning behind it, I have my own theories. So let's take a look at how much the estimated damage is. I can't remember right now. It's about 31 mil or 81 mil, somewhere between that range, just a minuscule amount, like a drop in the ocean compared to the legacy derivatives markets that you have, like people on Instagram running around in Lamborghinis, advertising, telling people, go ahead, trade these, you'll make money, you'll become a millionaire. But specifically crypto leverage trading, that's what's damaging to people. And let's just take it out of the trading realm as well. Casinos. Football teams are allowed to have casinos on their shirts and publicly advertise those, but that isn't dangerous. Crypto derivatives trading is. It makes very little sense when you try and look at their actual reasoning. But when you take a step back and look at it from the more, because at the end of the day, when you're young, you think governments are these machines that just go and normally make the right decision, but it's people behind these decisions. It's people that decide what to do. And in my opinion, the governments want to stop crypto and then reintroduce these things on their playing field. So they want us to play by their rules. It's so take away everything and then slowly reintroduce it. And that way they can have very strict control over what's allowed and what isn't allowed, especially with something that they don't understand. These are inefficient large engines that move very quickly. And the safest thing for them to do is to just put blanket bans on and then reintroduce it as and when they're comfortable.
Well, luckily, this industry is pretty decentralized and it's pretty easy to get around these bans. I'm not telling you what to do. I'm sure you'll figure it out yourself. Koroush, thank you so much for joining us and really explaining to us and giving us, kind of this, your thought process and obviously a very well thought out thought process about how you trade. So I do appreciate you taking your very precious time. And I'm sure our viewers do too. And for all of our viewers here at Reimagine 2020, I'm Yonah Hochhauser with Koroush. Thank you so much for watching.